What I'm about to share with you is one of the most fascinating and instructive stories in the history of personal finance. It involves one man, one legal strategy, and one outcome that most people have never heard of and that almost nobody has ever explained in plain language. My name is Lee Boone. I am the founder of Buckeye Financial LLC, and I specialize in one thing: helping people build, protect, and transfer wealth in the most tax-efficient way legally possible. This presentation is called the Thiel strategy, built for the rest of us. And by the time we are done, you're going to understand exactly how one man made $5 billion without paying a single dollar of federal income tax on it. And more importantly, how the same destination is available to you right now through a vehicle that does not require anything he had to have. Let's get into it. In 1999, Peter was a co-founder of a small payments startup called PayPal. Before the company had meaningful value, when shares were trading at fractions of a cent, Thiel contributed those founder shares into his Roth IRA. The total contribution stayed within IRS limits at the time. What happened next is the part that changes how you think about money permanently. PayPal grew into one of the most valuable companies in the world, and according to a 2021 investigation by ProPublica, a respected nonprofit investigative news organization, his Roth IRA had grown to approximately $5 billion by 2012. $5 billion tax-free. Every dollar of that growth inside a Roth IRA, untouched by the federal government. Now, let me answer the three questions I know you are already asking. Was it legal? No. It was precise and strategic use of a vehicle that has existed in the tax code for decades. Was it available to everyone? Technically, yes. Practically, no. Because almost nobody knew it was possible, and very people had access to pre-IPO assets at near zero valuation. And can you do exactly what he did? No. And I'm going to explain exactly why in a few minutes. But here is what matters: the destination he reached. Tax-free growth, tax-free income, zero IRS involvement is absolutely available to you right now through a different road. That is what this presentation is about. There is one rule the wealthy never break. Before I show you the vehicle, I want to make sure you understand the principle behind why any of this works. Because if you understand the principle, you will never look at your finances the same way again. The rule is this: never pay taxes on money that does not have to be taxed. That's it. That is the whole game. The tax code has always contained vehicles designed specifically for tax-free growth. Roth IRAs, life insurance, certain municipal bonds. These vehicles have always been available. Wealthy families and their financial teams have understood and utilized them for generations. Now, why have most people never had these conversations? It is not a conspiracy. It is not a licensing reality. Most financial advisors are licensed to discuss stocks, bonds, and mutual funds. Insurance-based tax-free strategies require a different license and a completely different conversation. Most people simply never get access to that conversation, not because it was hidden from them maliciously, but because the person sitting across from them was not positioned to have it. The result is a gap in knowledge that costs the average family hundreds of thousands of dollars over a lifetime in taxes that legally did not have to be paid. This presentation closes the gap. Now, before I show you the vehicle I actually want to talk about, I want to give the Roth IRA its full credit, because it is a genuinely powerful tool and it deserves an honest assessment. The Roth IRA grows tax-free. Qualified withdrawals in retirement are tax-free. There are no required minimum distributions during their owner's lifetime, and it passes to heirs with significant tax advantages. For the right person at the right income level, it is an excellent vehicle. But here is where it runs out of road for someone at your level. The IRS caps contributions at $7,000 per year. That is a hard ceiling. If your income exceeds a certain threshold, and for most people watching this, it does, your ability to contribute directly phases out and eventually disappears entirely. You make too much money to use the gold standard of tax-free savings. On top of that, there is no downside protection. If the market drops 40%, your Roth drops 40%. There is no contractual death benefit, nothing guaranteed to your family, and there is no long-term care provisions whatsoever. The Roth is a strong vehicle, but it was not designed with high-income earners in mind. There is a vehicle that was, and that is what we're going to talk about right now. I want to be completely honest with you about why you cannot simply do what Thiel did, because I think the honesty here actually makes the rest of the presentation more powerful. Thiel had pre-IPO access. He was in the room when PayPal was being built. He had access to founder shares before they had meaningful value. Most people will never have that opportunity. The strategy also required precise valuation timing. The assets had to be legitimately valued at or below the IRS contribution limit at the time of contribution. Getting that right requires specific circumstances that are extremely difficult to replicate. Then there is the concentration risk. Thiel bet his entire Roth on one company. PayPal won spectacularly, but the overwhelming majority of startups failed. The people who tried to copy this strategy with companies that did not succeed, they lost everything in that account. And finally, following the 2021 ProPublica reporting on Thiel's account, the IRS significantly increased scrutiny of self-directed Roth IRA valuations involving private company shares. The landscape today is far more complex than it was in 1999. So what is the takeaway? Thiel's outcome required rare access, precise timing, and a bet that paid off spectacularly. You cannot replicate the road he took, but the destination, tax-free wealth, is not only still available, there is actually a better road to get there. The vehicle is called an indexed universal life policy, an IUL. I want to introduce it to you not as an insurance product, but as exactly what it is when structured correctly. A tax-free wealth building engine that happens to have insurance attached to it. Period, point blank, end of discussion. Let me walk you through why it addresses every single limitation we just talked about with the Roth. First, there are no income limits. Unlike the Roth IRA, your income cannot disqualify you. A billionaire and a business owner sit at the same table with this vehicle. Second, there is no hard contribution ceiling. Premium amounts are determined by the policy structure and IRS guidelines around what is called the Modified Endowment Contract line, the MEC line. Policies must be structured carefully to stay below that line, but the amounts available are far beyond $7,000 Roth caps. Third, the cash value is indexed. It is tied to a market index like the S&P 500. You participate in market upside, up to the cap, or participation rate, without participating in market losses. Fourth, and this is critical, most policies carry a floor of 0% or above, meaning in a year the market drops significantly, your cash value does not go backwards. Floors vary by carrier and policy, so always confirm with your specific illustration. Fifth, distributions structured as policy loans are not considered taxable income under current tax law, specifically IRC Section 7702. Zero taxes on the growth, zero taxes on the income, and death benefits pass tax-free to your family under IRC Section 101A. And sixth, many IUL policies include riders for long-term care, chronic illness, and critical illness. Protection the Roth IRA simply cannot offer. Thiel needed PayPal to become one of the most valuable companies in history. You need a premium payment and a properly structured policy and time. Just a second. I want y'all to see that at the bottom. Forgive me. All right, let's move on. I want to put these two strategies side by side so you can see the comparisons clearly. Because when you see it laid out this way, the choice becomes obvious. Thiel's approach required pre-IPO company access. The IUL requires only a premium payment and a properly structured policy. His approach had a hard IRS contribution limit of $7,000. The IUL premium is determined by the policy design within MEC guidelines, far more flexible. His Roth had income phase-out limits that restricted high earners. The IUL has no income restrictions of any kind. His entire account was concentrated in a single company. The IUL is indexed to a broad market, not dependent on one company's success or failure. The Roth had zero downside protection. A market crash hit his account directly. The IUL carries a floor of 0% or above, depending on the carrier and policy. Your cash value does not go backwards. His Roth had no contractual death benefit. The IUL carries a tax-free death benefit under IRC Section 101A. And his Roth had no long-term care provision. The IUL has living benefit riders available on most policies. Both roads lead to the same place, tax-free wealth, but only one of them requires luck, rare access, and a perfect bet on a single company. This strategy does not require luck. It requires a decision and the right advisor. Now let me show you what this can look like in real numbers. And before I do, I want to be very clear about something. What I'm about to show you are hypothetical illustrations based on historical index performance and carrier assumptions. They are not guarantees. Actual results will vary based on policy design, the carrier you work with, premium amounts, index performance, and applicable policy charges. A personalized illustration specific to your age, health, and financial situation is required before any policy decision is made. I say that not to diminish what you're about to see, but because I want you to trust every number I put in front of you. With that said, here is what a hypothetical, properly structured IUL can look like. Okay, so a person starts at age 45. They fund the policy at $3,500 per month. Over 20 years, that is $840,000 in total premium. Based on historical index performance, that projected cash value at age 65 falls somewhere between $1.4 million and $1.9 million. For that cash value, the policy can generate between $8,000 and $11,000 per month in tax-free income for life, structured as policy loans under current tax law. Zero taxes on the growth, zero taxes on the income, and the death benefit passes to the family tax-free. Now, I want you to think about that alongside the Thiel story. Thiel used the tax-free principle on a $5 billion outcome. This vehicle applies that same principle to a retirement income strategy that is available to you right now, without the risk he took to get there. Before I make the ask, let me take a moment to tell you who I am and why I'm passionate about this specific conversation. I have been in the insurance and financial service industry for over 20 years. I have worked with families across Virginia, Maryland, North and South Carolina, Arkansas, Texas, Ohio, and Tennessee. My practice focuses exclusively on tax-free retirement income strategies, specifically index universal life, fixed indexed annuities, and retirement income planning that is designed to minimize what the IRS collects over a lifetime. I am not a CPA, and I am not a licensed investment advisor. I specialize in the insurance-based strategies that most financial conversations never include. Before all of this, I played defensive back at The Ohio State University. I was part of the 2002 BCS National Championship team under the great coach Jim Tressel. I mentioned that because everything I learned in that program, which was preparation, discipline, and protecting what matters, as well as executing when it counts, is exactly how I run my practice. When I come across the Thiel story, I was not surprised that his strategy worked. What struck me was how many people had never been shown that destination he reached is available without the risk he took to get there. That is the conversation I show up to have every single day. And right now, that conversation is available to you. Let me leave you with this. Peter Thiel is not smarter than you. He did not work harder than you. He did not deserve a tax-free fortune more than you deserve one. He simply had a conversation at the right time with the right people that most people never get invited to. The tax-free wealth building principle behind his $5 billion account was never illegal. It was never unavailable. It was simply a conversation that most people were will never positioned to have because the advisors in front of them were licensed in a different lane and simply did not offer the vehicles that make it work. You now understand the strategy. You now understand the vehicle. You now understand what the numbers can look like and what it's required to make them real for your specific situation. The only remaining question is what you do with that understanding. Here's what I know about the people who watch a presentation like this. Some will think about it and come back later. Some will share it with someone they trust. And some, the ones who are genuinely ready, will take one action before they close this window. They will scan the QR code that you see on the screen and schedule a 15 to 30-minute strategy session. Your numbers, your situation, your specific policy illustration with no pressure, no obligation, just a complete conversation. Finally, every year you wait is a year of tax-free compounding you cannot get back. The vehicle exists. The strategy is legal. The conversation is right here. Scan the code and let's talk.